One thing the Fed keeps a very close eye on is housing. And today, just as mortgage rates hit a 2-year high, applications for new mortgages fell by 4%. And it's those rising mortgage rates that's creating sticker shock for home buyers. Diana Olick has that story.
At a broker's open house in Northern Virginia,
table and chairs there.
Agents are sizing up this single-family home and recalculating what their clients can pay now that mortgage rates are far higher than they were just 6 weeks ago.
It has gotten a lot quieter, which is a shame because historically the rates are still very low.
I've heard some people say, well, that's going to really cut down on business because people are now going to say, hey, I missed the boat. I'm going to hold off. I'm not going to go out and purchase.
Mortgage rates are now a full percentage point higher than they were in early May. But it's not so much the rate, which is still historically low, it's the sharp jump.
We had this spike happen, 45% jump in mortgage rates from 3.5 to 5 over the period of 6 weeks. I can find no precedent for that. The only precedent I can find for that is the loss of the homebuyer tax credit in mid-2010.
That stimulus, which Hansen calls small compared to the government-induced 3.5% mortgage rate, caused a huge drop-off in sales of new and existing homes when it expired. New home sales fell 38% in a single month in the spring of 2010.
My biggest concern is we're just not going to have demand anywhere remotely close to what we had 3 months ago, 12 months ago, when this super Fed stimulus was in place.
Compounding the rate shock is sticker shock in home prices, as very tight supply has buyers outbidding each other.
I think that it's been a lot of pent-up demand from buyers who want to buy right now, and plus with the rates going up, that the buyers, they want to act right now.
The question is, how long will that last? In May, we did see a rush to buy as rates started going higher. Signed contracts hit a 6-year high. But that was before the recent spike. And while rates at 5 or 6% are not historically high, it was the spike that spooked the market. And the fact that for consumers, 3.5% had become the new normal. For Nightly Business Report, I'm Diana Olick in Washington.